Chuck Carvel, and I'm the Chuck in the Markets Up Chuck. And to kind of conclude this week's discussions about the importance of valuation, we've titled this blog "The Different Facets of Valuation" because I do want to make some distinctions in the in today's kind of weekly closing set part of this portion of this blog. I'm going to start with Home Depot. I'm going to show you here a 20-year chart of Home Depot. What I want you to notice is that Home Depot had a string of extremely good earnings growth all the way up through 2007. And then we went to the period 2007 and 8 and then into 2009 where earnings, obviously due to the recession in the housing situation, earnings fell precipitously. But there's several actual lessons here in the Home Depot chart. First of all, there was a period where there was irrational exuberance where the stock price got disconnected. Now, one point I want to make is from that point, Home Depot fell from about $68 a share roughly in 1991, and then fell almost immediately down to $39. But the point I want to make here, even though you had this precipitous drop in price, Home Depot was still significantly overvalued. It kind of floundered around for the next year before it ultimately came back down to its fair value, which was $23 a share. So just because the price drops doesn't mean valuation exists. The other point I want to make on the Home Depot chart is as you look towards the end of the year here, Home Depot stock price has fallen, clearly since, say January of 2007, but what it's really done here is followed earnings down, and I think that's the key point. Earnings do determine market price in the long run, and Home Depot stock price, in this case, is following earnings. So I might say that Home Depot might be in value now, but it's not undervalued relative to the amount of earnings it's currently generating. My next example would be Abercrombie & Fitch, and I want to make the same point and kind of reiterate the same last point I made with Home Depot. I want you to notice that there's a lot of volatility around the earnings line here, but in the long run, the earnings did track stock price did track earnings here. And when there were periods of overvaluation, the price fell. When there were periods of undervaluation, the price rose back to value and then often exceeded it, or in a couple of cases just came back into value. The point is prices cannot be reflective of true valuation at any point in time, but what actually happened with Abercrombie & Fitch during the last year or so in the recession, the stock price fell precipitously, from a high of, 79, actually it was in the 80s, and dropped all the way down to 13, but it also followed its earnings down. So it wasn't necessarily undervalued at this point. Now I'm going to conclude this and contrast this with a picture of TJ Maxx here, TJX Companies. What you really see here is a company with very consistent earnings growth. They've been paying a decent dividend for the last several years. I want you to notice the stock price has tracked earnings very carefully. And then we had this situation. We actually had earnings do extremely well and are doing extremely well in 2009. And part of it because it's a discount, retailer. The stock price fell precipitously, but this is what I really talk about when I talk about undervaluation. Earnings still justified a much higher price, and as a result, TJ Maxx's stock price has, obviously and very quickly come back into earnings. So, valuation is a function of what the company's actual earnings justify. And I think the key point is, as I mentioned in yesterday's blog, these are mathematical charts. At these levels of profits, a normal price earnings ratio of 16 times earnings is clearly an attractive valuation to TJX. And so when the market was mispricing on the downside, it did get undervalued, and it did, of course, come back into value. So, there are many different facets of valuation. The key is to know what your business is worth, and the key is to understand where earnings are relative to the price you're paying to buy the stocks that you're looking at investing in. It's Chuck Carvel saying, hoping that this week's blogs gave you some better perspectives on the importance and the way valuation can affect long-term returns. As usual, it's Friday. I'll be taking the weekend off. Y'all have a great weekend, and thanks for listening. Look forward to talking again on Monday.